Hey everyone, welcome back to another episode of Finance Shminance. Wanted to take a minute and talk about inflation. And that's something that I've been talking a lot about lately because it has had a real impact on us as investors. In December 2021, the year-over-year inflation rate for consumer prices, that's the price that we pay for stuff at the store and for services that we purchase, it was up 7% year over year, far higher than it should be, the highest rate it's been since the early 1980s. And as a result, the Federal Reserve has indicated it's going to start hiking its short-term overnight interest rate to try to get this inflation back under control. Basically, they're trying to let a little bit of hot air out of the economy so that inflation maybe doesn't run so high. Talked a lot about that as of late, about what that means for stock prices, higher interest rates. Essentially, it lowers the present value of a stock. As long as our businesses are still growing, nothing we really have to worry about in the long run. But what does this inflation narrative mean for us as investors in the short term? Well, I do want to share a chart with everybody that is put together by the U.S. Bureau of Labor Statistics. I think this is a really telling chart to take a look at because it helps put inflation in the context of the bigger picture. So what this chart is showing is the year-over-year rate of inflation. And here on the right-hand side, you can see this is the latest print from December, 7%. It's been running well north of 5% here for the last few months. Most of that is caused by primarily two items: energy and vehicle cost. Of course, we're lapping a period where last year nobody was leaving the house, basically, no one was driving. So of course we can expect a big jump in inflation this year. And you can see that here in the chart. Here's the dip when the pandemic started in early 2020, and really throughout 2020, inflation was really quite low, much lower than it should have been, which is the opposite of the problem we're having now, where it's higher than it should be. In fact, in December 2020, inflation was just 1.4%. So when you average that with the 7% that we just had this past December, the average 2-year inflation rate is just 4.2%. Certainly a little bit on the high side, but not terribly out of control, especially given some of the issues going on in the economy with like the supply chain, the semiconductor shortage, and other related things like that. So what's the lesson for us as investors in the short term? Inflation can have an impact on our portfolio. However, as useful as data can be, it can also be manipulated to satisfy a narrative purpose. Essentially, at this point, it's going to mean higher interest rates. The Federal Reserve, it needs to raise interest rates. But it certainly doesn't mean runaway inflation is here to stay for the long term. This is probably going to be a short-term effect related to the deflationary forces that were at play just a year ago. These things will work themselves out. So we don't need to get carried away with the inflation narrative just yet. Second lesson we can take away from this: ignore the crisis of the moment. The vast majority of crises are going to abate very quickly, and we're just going to move on to the next media hyped dilemma and get another reason to worry. Instead of focusing on the crisis of the moment, focus on what we can control. Keeping our emotions in check, staying invested in quality businesses, and making sure that we're staying invested in those quality businesses for the long term. Businesses that can manage the effects of inflation, and especially those that can outgrow the inflation rate. So 2 helpful takeaways: don't get too hung up on the short-term data. It can change very quickly. As far as indications are looking, inflation is probably going to moderate this year and into 2023, not going to be a long-term issue. and ignore the crisis of the moment. Our stocks are going to be just fine if the underlying businesses that we're invested in continue to do well and continue to grow.